Louis Vuitton stock is down 20% in the last year and is currently trading right at their 52-week low. But here's what's interesting about this. If we look at insider purchases for this company over the last year, we can see insiders have been on a buying spree. But look at just the past couple of weeks alone. We can see multiple instances of insider purchases, and not only insiders. Most of these purchases are from the founder Bernard Arnault himself. Look at this. He bought shares on November 19th, November 18th, November 15th, the 14th, the 13th, the 12th, and November 6th. So he's been on a huge buying spree over the past few weeks. And this reminds me of the old Peter Lynch quote, "Insiders might sell their shares for any number of reasons, but they buy them for only one. They think the price will rise." So when you see that many insider purchases, especially from the founder himself, that gives me a lot of confidence. And keep in mind, Louis Vuitton is actually a stock I added to my personal portfolio earlier this year. If we look at my position, let's jump over to my do-it-yourself investor toolkit and blow up my growth chart. We can see I'm currently down around 11.43% on this position. Now, obviously, when you buy a stock and you see it go up in the short term, that's a great feeling. It makes you feel like you made a great choice. But if you're confident in the position, then technically you would want to see the stock go down, because it allows you to continue to build up that position at even better prices. And that's what Bernard Arnault's doing, and I think I should probably consider doing the same. But with the sell-off over the past year, we have to ask ourselves, has anything fundamentally changed about this business? Is the future outlook no longer as bright? And is the stock trading at a good price? We're going to address all those questions in this video. Now, the first thing that I want to talk about, again, we're going back to Bernard Arnault. Yes, there's a ton of insider purchases over the past year. But here's what's really interesting about this. If we jump over to the 2023 annual report, this is about a year ago. We can see December of 2023. Look at the shareholder structure for Louis Vuitton. 7% of shares are owned by individuals, and we have maybe close to around 44% are owned by institutional investors. But over 48.6% of the shares are still owned by the Arnault family group. And again, this was as of the end of December of 2023. After all these insider purchases, it's likely even higher, maybe as high as 50%. Now, this is interesting for one main reason. Stocks that are primarily owned by founders / the original owners typically outperform over the long term, and we can see an example of this listed here. And that's because founders and owners are focused on long-term wealth creation. They're focused on growing earnings over the long term, even if it means facing headwinds over the short term. That's not always how the management team is incentivized. Management teams typically get more praise for solid quarterly earnings reports or even flashy acquisitions. For example, management teams can artificially boost earnings per share simply by using their capital to buy back shares. So when I see the Arnault family group already owning the vast majority of shares outstanding for this company, and they're still constantly buying shares, again, I get a lot of confidence in this company. Now, we need to address the headwinds though. Why is the stock down 20% in the last year? And a lot of this boils down to one thing, and that is weakness in the Chinese market, more specifically the Asian market as a whole. If we scroll down, one of the things we can see is reported organic revenue fell 3% year over year in fiscal quarter 3, which is also below what estimates were. They were expecting around 1% growth. And here's the big concern: overall organic revenue for Asia, not including Japan, was down 16%, so that's a massive drawback. Now, this was addressed in the recent earnings report, and we can see one of the things that was stated is they're still very strong believers in the future of luxury goods and in the future of the emergence of upper middle class in China and elsewhere. They stated they see absolutely no reason why after a cyclical downturn as we are experiencing today, we should not be in a position to be able to recover. So yes, the management team is expecting a recovery, especially in the Asia markets over time. Now, when we talk about the company needing an economic recovery in a specific place like Asia, that doesn't happen overnight. That takes a few years at a minimum, but there are actually some short-term potential catalysts. Now, what am I talking about? Well, China has recently unveiled a 1.4 trillion stimulus package, an effort to boost their economy. And recently, economic advisors have been calling for even stronger stimulus packages. This would be a huge boost for Louis Vuitton over the short term. But again, as a personal shareholder in this company, I'm not as concerned about the short term as I am about the long term. And while I have no idea how the economy in Asia will do in the short term or whether or not stimulus will get passed, I still feel good about Louis Vuitton being able to grow their earnings over the long term. And for example, if we jump over to my stock screener, let's go ahead and look at the historical earnings. I'll plug in LVMHF and hit enter. And all this data will automatically load in thanks to Ticker Data. And like always, you can download any of my spreadsheets and also get access to the Ticker Data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet by going over to tickerdata.com. We're actually currently hosting a Black Friday sale. You can get 30% off the yearly options plus 17% off for selecting the yearly plan. So there's a huge discount right now, so go check it out. There's also a 7-day free trial. Now, back to what we're talking about with Louis Vuitton. We can see earnings over the past decade have grown at a pretty rapid rate. 2013 earnings per share of $6.87 and at the end of 2023, all the way up to $30.33. Obviously, we can see a pretty big dip here when COVID happened, but the recovery was astronomical. They went from $9.34 to the next year $23.90. So the stock performed really well during this time. We can see the same was true with free cash flow per share, but there has been a little bit of drawback over the last couple of years. But revenue per share, revenue on a per share basis has continued to grow. Now we don't have full 2024 numbers yet, but it looks like there's going to be a slight decline in 2024. So maybe we'll see it come in somewhere around right here. Now if we go ahead and jump over to my profitability sheet, the main thing we want to talk about with Louis Vuitton is the gross profit ratio, the gross margins. This is a company that sells luxury goods, and because of that, they have what I would call luxury margins for a retail company. Their 10-year average gross profit ratio is sitting at 66.23, and as of 2023, last year was sitting at 68.8%. So they have phenomenal gross profit margins for the goods that they're selling. We can see the 5 and 10-year revenue CAGRs, both above double digits. The same is true with net income. Now, if we go ahead and jump over to the dividend breakdown sheet, again, we'll come up here and plug in LVMHF for Louis Vuitton. What we can see is the company now has a starting dividend yield sitting at 2.24%. And let's go ahead and put this into perspective. If we jump back over to Seeking Alpha and look at the historical dividend yield for this company for the past 5 years, we can now see they have their highest starting dividend yield in the last 5 years. And we combine that nice starting dividend yield with the fact they have a really nice dividend growth history, 10-year dividend CAGR of 14% and 5-year dividend CAGR of 15.2%. It's looking like a pretty attractive option, especially when you consider the fact the free cash flow payout ratio has been in a pretty healthy range for the past decade. Now, it has climbed quite a bit higher over the past few years, something to keep in mind. In 2021, it was as low as 24.37%, but as of last year, it's sitting at about 59%. So 59% of their free cash flow last year was used to pay out dividends. Now, keep in mind, Louis Vuitton is a European company, and because of that, dividends are going to look a little bit different. European companies don't always pay out dividends on a quarterly basis, and in fact, Louis Vuitton actually pays it out on a semi-annual basis. And there can also be differences because of currency fluctuations if you're an American investor. And also keep in mind, you want to make sure you understand the tax consequences when you invest in foreign stocks. With all that being said, it's clear there's a good history of growing those dividend payments over time, and it's clear why they're able to do that. Free cash flow has done a tremendous job of growing over the past decade. So when I look at this company, it does fit into what I'm looking for my long-term positions in my personal dividend portfolio. I'm looking for companies that are growing free cash flow at a high rate because that allows them to grow their dividend payments at a high rate. And that's exactly what has happened with Louis Vuitton. Now, the question we need to ask is Louis Vuitton trading at a good value at $620.30 per share right at its 52-week low? And let's go and address it by looking at a few different scenarios. Now, the first thing I want to look at is going to be a reverse discounted cash flow analysis. And again, what this is going to tell us is how much growth is currently priced into Louis Vuitton. So for example, we can see as of right now, assuming 0% free cash flow growth for Louis Vuitton, the company would be worth around $222.55 per share. But they're currently trading at about $624. So what does this tell us? Well, the market is pricing in free cash flow growth. So exactly how much free cash flow growth are they pricing in? Well, let's go ahead and bump this up to around 10%. We can see that puts the reverse DCF at about $515 per share, so the market is pricing in even more. If we bump it up to around 12%, it gets closer to about 601, and if we bump it up to around 12.5%, we can see we essentially get the same price as the current trading price. So the market is pricing in around 12.5% free cash flow growth. I'd argue that over the long term, I actually expect it to be even higher than that. So in fact, if we go ahead and jump over to my stock valuation spreadsheet, I've already plugged in Louis Vuitton. Let's focus on two different valuations. We'll first look at our discounted cash flow analysis. Let's go ahead and zoom in. And in this scenario, I'm assuming around 15% free cash flow growth for the future free cash flows of the company. We then add those future free cash flows together, add the cash and cash equivalents, and subtract out total debt to get equity value, divide by shares outstanding, and come to a DCF price per share of around $754.37. Now here's the valuation that's really interesting, the dividend discount model. Assuming just 7% growth rate for the future dividends and an 8.5% discount rate, we come to a dividend discount model price per share of $999.38, way higher than the current share price for the company. And like we've already seen from the dividend breakdown, they've easily been hitting those dividend growth rates over the long term. Sure, maybe dividend growth will be a little bit slower over the next couple of years as they face headwinds in China, but I think long term that 7% dividend growth rate is attainable for the company. And so if we jump over to the output tab and look at the two valuations that we did use in this scenario, we come to an intrinsic value of about $877 per share, which is around a 29% difference from the current trading price. So with a 10% margin of safety, the acceptable buy price is around $789, and with a 20% margin of safety, it's That's around $700, and we're getting a buy signal in both scenarios. If we want to take things even a step further, if we jump back over to Seeking Alpha and go over to charting, if we look at the price to cash flow ratio for Louis Vuitton, it's the lowest it's been in the last year. It's currently sitting at about $14.95. And if you look at the past 5 years, it's pretty much the lowest it's been in the past 5 years, with the exception of 2020. So again, compared to how it's historically traded, even then, it looks undervalued. So for people looking at the short term, it's easy to see why there's concerns about Louis Vuitton right now. They're really struggling in Asia, and that might continue for another couple years. But for people looking at the long term, like Bernard Arnault, I think things look pretty good for this company. But go ahead and let me know what you think of Louis Vuitton stock in the comments down below if you plan on buying or selling. Like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, you can head over to tickerdata.com at the link in the description. There's currently a huge Black Friday sale. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.